Hello and welcome to yet another live session, and this session is very special because most of the investors, they keep grinding for long years but they are not able to beat index returns. And if you think about it, mutual funds are also not able to beat index return. If you see like 70% of those mutual funds, right? So in today's session, what I'll be dissecting for all of you is how you can follow a system, how you can follow a process, what all things you can do to beat index returns and compound your money at a better rate. So let's dive in. If you are all ready, just type ready in the comment box. Awesome. So let's start with some of the points which are very important to understand the starting point. As I said, the two concepts which we need to understand is first, whether active or passive. What is passive? Where you just put money somewhere and you are not bothered about it. Active is where somebody is managing your money. It may be your fund manager or it may be somebody directly who is managing your money, right? So what is important, whether we should go for a passive fund or an active fund, we should do it passively or actively. क्या म्यूचुअल फंड्स रियली में सही है या नहीं, right? So to give you the context, as I said, 70% of the mutual funds on an average across the globe are not able to beat index return. What I mean by index return is Nifty or Sensex return or whatever country it might be, they are not able to beat the index returns. And then it is so much difficult to find right kind of mutual fund also for an ordinary investor. So that is a big pain point if you think about it. And you can check your mutual fund returns, by the way, yourself and see whether they have beaten Nifty returns or not. If they have not beaten Nifty returns, that is the starting point. You need to wake up and see whether you are doing a right thing or you are on a wrong path. The second point which comes in is whether I should then directly put money into index ETFs. Or should I do it directly myself? There again, there is a point, there is a fees which even ETFs has to pay. There is a tracking error, and I'll show you what is the long-term compounding result because of that versus direct investing. And if you think about it, today's time and age, direct investing, you can do it almost free because, brokers like Zerodha are, not even charging brokerage for long-term investing. So if you are considering direct investing, and I'm sure a lot of you are thinking about it because that kind of returns which it can generate is far humongous once I show you the entire process. So what to do and when should you consider direct investing? So that step-by-step process I'll be discussing in the main segment after this. Now, second point is very important as an investor is setting goals. A lot of people don't have a mindset itself that I can achieve this kind of returns. They are just comparing the equity returns with FD returns or real estate returns, which are not right way to compare it, or even gold returns, right? So when you are investing in equity, inherently you are taking slightly more risk. You agree or not, but you are inherently taking slightly more risk than FD and all other safer instruments, right? So the minimum what you should be aiming for is to match your index returns. If you are not performing at least what Nifty is performing or Sensex is performing, then there is something is seriously wrong in the process. And when I discuss all these points, you will realize, you will be able to relate which points probably you might need to work upon or improve upon. And you might also get some techniques and strategies where you can apply that. Second question which I keep getting is it possible to beat index return? Like, Vivek, is it really possible to, beat index return? And my answer is hell yes. Okay. Lot of members in my community have done it. If you think about people like Mark Minervini, they have like beaten Nifty returns, index returns by big margin. Like last year, what Mark Minervini did was somewhere around 300% kind of return, right? So if you are actively doing it as an individual investor, you get lot more advantage compared to other investors, right? So it is possible to aim for higher returns, and if you do it rightly in a correct way, it is possible. Okay. Now, what kind of return you should be aiming for? That is the next question, right? So you say that, Vivek, yes, I agree that I can probably aim for higher returns, but what is the ideal, return percentage which I should be aiming for? So minimum return which you should be aiming for is at least 25% compounding. So on an average, if you think about Nifty, over a long period, it has given average 15% return so far. And if you are doing it actively, if you are putting your head, at least compound at 25% rate. And what does that translate to? Is if you compound at 25 to 26% kind of return, your portfolio will double in 3 years. And I've done a podcast also, you can just check it out later on. And even Ramesh Damani has said this concept. What happens if you keep compounding like this? Your 10 lakh will actually become 100 crores without any incremental capital in 30 years. Okay, so that is a very, very decent figure. Like if you are at 25, think about it. Like at 55, you are getting 100 crores from 10 lakh of investment. How great is that? Right? And that is the minimum you should achieve, and you can achieve. Once I show you the step, you will also realize how it can be done. Right? So the first thing as an investor, what you should do, first and foremost thing as an investor, I would say is respect risk. Okay. Respect risk. And when I also discussed with Mark Minervini, we had a session, I was also interviewing him. That is the point he emphasized. Actually, I would like to give credit to him, because this is what he told, that as an investor, you need to respect risk. If you are following this, just type RR, respect risk, in the comment box. Because in the market, what happens is you don't have to be brilliant. Like you don't need to be a rocket scientist to get great returns. Like if you think that, Vivek, I don't have a CFA degree, I don't have a PhD in mathematics, it's not needed always. Okay, so if you apply your common sense, do right things and avoid blatantly wrong things which you should be not doing in the market, you can still make a lot of returns. Like I'll give you an example of LTCM, right? So LTCM was a fund by Nobel Prize winners in mathematics and statistics. Okay, and what they did is they created all the kind of fancy sophisticated model. They leveraged their portfolio, and this was the result. You can just see the graph, the blue line which is there. That is what was the result for LTCM. And why did that happen? I'll tell you about it. Why did that happen and how you can avoid it is very, very important as an investor. Okay, so how you can respect risk is these points. Okay, let me just share the screen and just note this down. And guys, this is very, very important session which I'm sharing with you. So make sure you take a lot of notes and you follow this properly. Okay, otherwise it's of no use. So first thing you have to do is you have to invest with patience. Okay, you don't go all in day one. Like a lot of people make that mistake. Even they are buying a good core portfolio company like Nestle, Pidilite or Asian Paints. Even in the peak of the bull market, just they go all in. You don't need to go all in. You take a first small tranche, have a patience, and then slowly you can build your position. Second point which you should focus is you should have a process. If you don't have a right process in place, nothing is going to happen, right? And most of the investors I have seen, that is where, the problem generally lies. And the third point is mindset. Like if you don't have a winning mindset, if you don't believe in yourself, if you think like a loser, again, this is not the game for you. Okay. Very important lesson which I would like to urge all of you, and I have made this mistake. So a lot of these things which I'm talking to you, I have made these mistakes myself, right? Don't indulge in F&O and speculation. The LTCM example which I gave you was one because of the options and lot of these fancy things which they were using. And second was leverage. They were leveraging the portfolio. They were, multiplying the amount. They were borrowing money and then putting into the markets. Please, please, please don't do. Never take leverage in the markets. Invest with your own money, which you don't require in a near term. If this is making sense, just type MS in the comment box. You will see a lot of fancy screenshots. You will see a lot of enticing crypto thing and leveraging thing and margin stories and all that. But please don't do that as a retail investor, right? It is just the path of disaster. And particularly if you are, cross like 40, 50 years, it will be very difficult for you to bring back that capital in your life. Okay. The last point is having an exit system in the place. Okay, why exit system is important? Because if you have done everything right and if you have made profit, then you don't want to give back entire profit to the market. And if you want to do that, the only and only solution is to have a exit system in place. Okay, are you with me so far? Just type with you in the comment box. So that is the first point. Now, second point which we are learning is develop an investing system. Why an investing system is required? Because our emotions start playing with ourselves, right? When there is a COVID fall or demonetization, we get into fear. That is like human instinct. When there is bull market, we go into euphoria, we go into FOMO. So that is where the system is needed to protect us from ourselves. Okay, if you want to protect yourself, you need to build a system. And how you need to build a system and what kind of systems are required? Three kind of major systems are required. One is your buying, adding and selling system. How you will take buying decisions, how you will take adding decisions when you are, adding your positions, and how you will take exit decisions. Okay, so this is the first thing you should be doing, and I've shared the link in the description also. If you want to learn how to create these buy and sell systems, just check that out. The second thing which is very, very important is ranking system. And once I come to the next point, you will understand it better. But most of the times the investor make a mistake. They have a zoo of portfolio, like 50, 60, 70 companies. And they don't even know which is a great company, which is an underperforming company, where to allocate, where to not allocate, and which one to remove. If you want to take that decision properly, you need a ranking system. If you got this point, just type RS, ranking system, in the comment box. So second thing, you need a ranking system. Third thing, you need a allocation system. Because I have seen many investors, they might have, HDFC, Asian Paints or Bajaj Finance in their portfolio, but they don't know how to allocate well. So they might be just putting 1% into it. Even if it becomes 10x, how does it matter? It will not move the needle of your portfolio. That is where having a allocation system in your portfolio is very, very important, right? So three system: buying, adding, selling system, ranking system, and third is allocation system. That is the second point. Okay, so have a system in place. If you don't have it, work towards it. Okay, third is you need to have an approach where you can calculate backwards. Like if you want to achieve minimum 25% return, that is, if you want to beat Nifty returns by a huge margin, right? And what I mean by huge margin is there is a huge difference when it comes to that, right? So let me show you a picture which will give you an idea probably. So this is the kind of compounding, the fees and without fees it creates. So you can see, like if you have a slightly higher margin of percentage return, it is a great return. Okay, so let me come to the third point, where you need to follow a core satellite approach. And the entire investing system, how you can build and what should be the steps about it, I have covered in a separate video. So that is the reason I'm not spending too much time in depth into this, but you can watch this video which I have created, how to use the Amazon flywheel model to become a better investor. Okay, so just watch it later on. It's on my YouTube channel itself, but that is very, very important module. So you need to build a core satellite approach. I'll tell you about both these parts, why it is important and what does it contain. Okay, so the first is core portfolio. What is a core portfolio? Core portfolio is something which is focused towards your capital protection, because as an investor, the most important priority is what? Your capital, right? You have to manage risk and you have to protect capital. If you are in the game, then you can play the game. If you are out of the game, then you cannot play the game. So if you wipe off your entire capital, you will never be able to come back in the market, or it will take so long for you to achieve that same kind of compounding. So the first and foremost thing you should be following is capital protection, and that is where the core portfolio construct is very important. Generally what I have is around 70% of this portfolio which is into this core portfolio. Okay, now what kind of company should go inside this core portfolio? The companies which should go is something which is steadily compounding, which is like consistent compounding machine with a proven track record, which should have a long track record history, so that you are not fooled by any new age company which is like just coming and taking your money away, right? So it should be proven. The compounding engine should be working. It should have a solid foundation in terms of management, in terms of all the practices in place, the operations in place. And here you don't require less active monitoring, right? So you can just relax, buy it slowly, and then you can build it up. You don't need to be very active in terms of investing. And most of the times, if you see your mutual fund portfolio, some of these top companies are all known companies like Asian Paints and HDFC and all those companies. And that is why I keep telling that you don't need to pay a fund manager to buy a Infosys or TCS or HDFC or Asian Paints for you. How many of you agree with this? Just type agree in the comment box. Because when you pay that fees, as I showed you the diagram, your compounding in a long run drastically decreases, right? So for 1, 2, 3 years, it will not feel the pinch. But when you are in the game for long term, that fees which you are paying to buy that TCS, Infosys, HDFC for you to a mutual fund, that heavily underperforms your overall portfolio, right? So if you want to learn how to go about this entire process, and if you want to just replicate broad mutual fund into your direct portfolio, I did a workshop some time back, so you can just check it out. I'll share the link also below. If you want the recording of that, you can just grab it. Okay, so that is on why the core portfolio is important. And let me share the screen to share the different points. Okay, another point is you have to give more weightage to the fundamentals over here, right? Although I follow some core satellite exit strategies and all those things, but the starting point should be your fundamental analysis. Okay, when you start with fundamental analysis, it gives you a comfort that this is a proven company, there is a track record, and you can also use different screeners. So one of the screeners which I've developed is called Machine Formula, and there is a separate video which I've done on that, fundamental analysis of stocks using Excel screener. I've not covered entry exit over there, which is based on technicals, but it covers what are the different components and how you can efficiently use a template to do it. Okay, so that is how you select a core portfolio. Now in core portfolio, how the outperformance comes in. See, if you think about Nifty, they have some 60% of constituent like these kind of companies, which are matured company like Infosys, TCS, Asian Paints and all those kind of companies. But there are some cyclical companies also, right? And because of that cyclical companies, the Nifty returns are slightly less. And that is the reason it is like on an average 15% kind of returns. Now, if you are able to avoid cyclicals and those kind of, very dicey companies from your portfolio, and also if you have an exit system in place, when there is a deterioration in the overall portfolio, you exit those companies. If there is a degrowth in the company, then you are not basically holding your losers. So that is the benefit of having an exit system in place. The second thing which I told you, if you have a ranking system in place, you know which kind of bottom companies to kick out from your portfolio. So that also, amplifies your overall return. And the third thing is, if you have an allocation system where you automatically allocate more to your winners, like say if TCS is doing good, you put more weight to TCS than what is there in Nifty. Or same way, if Pidilite is moving, you put more weight to Pidilite if that is your winner in the portfolio. So if you follow these simple steps, these three things, you can easily achieve at least 5 to 10% outperformance. That means on your core portfolio, you are easily compounding at around 20 to 25%, right? And that is where you can also use this screener. I've also shared the link in the comment section, but I'll also just highlight the link. This is like a free gift from my end, so you can just download this Excel if you have not yet done it. I give it in each of my session because this is very powerful, and a lot of people charge 5,000 rupees for this Excel itself. Okay, so just make most use of it and make sure that you are using it in the right way. There is a video also explaining how to use that entire process. Okay, so hope you are clear so far. If you are clear so far, let's move to the satellite portfolio approach, how to do these satellite things and what is the thought process behind it, right? So the core is around like 70%, which is focused on capital protection, mediocre compounding around 20 to 25%. Now you will say, Dil mage more, I want to compound slightly more and I want to also find some multi-baggers. And that is the thought process of satellite portfolio. Okay, so satellite portfolio is basically oriented towards high growth in short term and potential long-term core stocks, which have not yet proven that they are going to be a long-term compounding stories, but they are showing some green shoots. Say for example, right now, the EV sector is picking up, right? And we don't know who will be the winner ultimately and whether any company in the EV sector will actually be a good compounding company like Maruti Suzuki, how it was in petrol engine and diesel engine. So that is where you experiment with these companies. Short term, they might show high growth potential, but if they continue it for long term, you keep on adding that position and ultimately you can also move it to the core stock. So that is the thought process behind satellite companies. And then you also benefit from sector tailwinds. So say for example, right now as I'm speaking, the hotel sector is having good sector tailwinds because the COVID thing has just opened up and hotel sector is booming. Then we have paper stock because of Ukraine war which is going on. Then we have sugar companies also which is getting benefited. And sugar, in fact, I had done a video 1 year back and since then a lot of companies have doubled. You can just check it out. I have an entire video on the sugar sector analysis done last year. Okay, just type sugar sector analysis Vivek Mashrani and you will find it. But that is the key, right? So if you are able to identify a sector tailwind, the stocks in that entire sector moves very, very swiftly within a short period of time. And if you've seen 2018, the graphite story, like HEG and Graphite India went 5-10x within no time. And same thing in COVID, right? So you had Zoom, which went from almost like $72 to $550 in less than a year. So if you are able to find these kind of sector tailwinds, it can make a lot of money for you. But most important thing here is you need an exit system, right? Because here you might have made a lot of money, but if you don't have an exit system, say you are not exiting somewhere here, you might lose your entire money, right? And I keep telling you cannot enter at bottom, you cannot enter at top. So what I, teach my members of my community is something called as stage analysis, which is a very, very important thought process where it tells you what stage you are inside this company and then you have an entry and exit system. You will always enter slightly higher than the bottom and you will always give back some bit of your profit. But the idea is once you have made the profit, you don't give back all of your profit. If this makes sense, just type MS in the comment box. Okay, so this is the reason to create a satellite portfolio. And this gives speed and alpha to your investment portfolio. And what you can also do here is, say TCS recently came for a buyback. If there is some special situation of delisting or demerger, these are like arbitrage opportunity where short within a short period of time, you can get 10, 20, 30% return. And if you can get 4 to 5 such position in a year, your portfolio returns will skyrocket, right? So here what I do is I give more weightage to technicals for entry and exit because you don't know, it's like an uncharted territory whether it will work out or not. And then I look at fundamentals. I have something called as 4-cylinder model where I look at fundamentals and see whether it is also having some kicker in terms of fundamentals as well. Now think about this. If you can get 4 to 5 big winners in a year, with 2x kind of return because of such moves, and you can get even more. I'm just giving at least, right? So how you can outperform is at least what I'm telling you. So you might even find 10 bagger with an allocation, and if you have a proper allocation system where you average up your winners and ride winners, which I'll come to the next part, somewhere 6th or 7th point, is where the magic gets created. Because if you have 2x 5 companies with 5% allocation, it will generate 50% portfolio returns just by these 5 positions. Now think about it. Your 70% is generating at least 20 to 25% and your remaining 30% is generating at least 40 to 50%. Can you beat index returns by a huge margin? The answer is hell yes. And a lot of members in my community have done it. Recently, we had Gaurav Srivastava, he made 161% return. We had Pratik who made awesome returns recently. He has done more than 100%. And so many such case studies we have, right? So it is not like it can be done or not. If you follow a process, it can be 100% done, right? The idea is you have to build a system, you have to stick to the system, rank your companies and then allocate well. That is the key to wealth creation, okay? So that is the 5th point. Hope all of you understood the satellite part of it. Okay, and core, you can also choose like a lot of monopoly companies, because there is so much of competition going on. So core portfolio you can select wisely, and I've also created a video, you can just check this out. Okay, so what are the top 10 such companies? You will get a lot of stock ideas also over there. And then on satellite, I've also created a strategy where you can learn about how Peter Lynch used to find these kind of new emerging companies and how he was able to generate a lot of returns. And the idea is very simple. Okay, so the idea is very simple. When you are finding these kind of companies, you will have a lot of unproven companies. Okay, I'll show you the quote of Peter Lynch and you will understand what I'm talking about. So what Peter Lynch says is, so I think it was just looking at different companies, and I always thought if you looked at 10 companies, you will find one that is very interesting and that might be growing, and in future it might be next Coca-Cola or next Asian Paints. And if I would look at 20, I might find 2 companies. And if I look at 100, I might find probably 10 such companies which are rock solid and they win the game. That is exactly what we are trying to do in the satellite portfolio, right? So hope now it is making sense in the entire context. Okay. So if this is making sense, just type clear in the comment box. Okay. Just type clear in the comment box. So this is on the powerful, strategy of the satellite side. Now, as I said, the next point which you need to focus is ride your winners. Okay. You need to ride your winners. If you find companies in your portfolio which are performing, you cannot get out very, very early. And that is the big mistake a lot of people do, that they get out of these great companies very early on. Okay. So don't make these mistakes. If you find a really good winner, just keep riding it and keep adding your position, because that is where the magic will get created. What you do when you are right, and what you do when you are not right, that is what makes the huge difference between average investing returns and mega compounding returns. Okay. So now let me tell you what you should do in riding your winners. So that is where, again, this is again from the book of Mark Minervini, is you should ride this entire stage 2 where the company is going into a super growth phase. Okay, and you have a lot of such examples. Like if you see Eicher Motors from 2010 to 2016, they were like roaringly growing in their operations. And if you had entered in 2010, you don't want to get out in 2011. Although a lot of investors do that mistake. If you are able to ride these 5 years of growth and compounding with 5 to 10% allocation, 2 to 3 such companies can change your life. And if you see all the other investors like Rakesh Jhunjhunwala and all biggie investors like Warren Buffett, all of them, if you see their portfolio, are concentrated 60 to 70% in top 4 to 5 winners only. Why do they do that? Because they understand this point, that it is very important to ride your winners. Okay, so ride your winners, understand the risk reward, and you need to develop an edge. Now you might ask how to develop an edge, right? So this is what again, Peter Lynch has also said, how you should be riding winners: water your flowers and cut out your weeds. And a lot of people do just the opposite. How to get an edge is like this. Okay, so what I do personally, and you can have your own edge. What I do is I blend technicals and fundamentals. So if you think about it, a lot of traders and speculators, they don't use fundamentals. They only use price volume action, technicals, and they have a short-term orientation, maybe intraday or few hours. A lot of investors, they just look at fundamentals and they don't know how to objectively exit and enter. And they don't use technicals, right? So they follow medium to long-term strategy, but they don't understand anything about technicals, right? So if I show you the Zoom chart again, if somebody is just following fundamental, there will be no news before it starts falling, because market will discount future. So that is where you need some different tools to also have a proper objective exits. And this is how you can blend both these things and you can get edge over your other peer investors. So you get edge over traders, you get edge over your fellow investors also. Hope this is what you are able to understand, right? If you are able to understand, just type understood in the comment box. Okay. So you have to understand that you need some kind of edge. And second thing in terms of riding your winners is, as I said, average up great performing businesses. Because if your portfolio has 2 to 3 performers also, and if you add more allocation to it, you will easily outperform your index returns. Okay. The seventh is save on fees, right? If you are putting money in mutual fund, today's time and age, all the portfolio of mutual fund is publicly available. You can create your own replica of mutual fund even if you are invested in mutual fund. Okay, so don't waste your money into fees, and it is a very simple process. Okay, so that is what I was talking about in this chart also, that on an average, if you remove the fees and transaction cost, on a long run, it takes away a lot of your compounding, right? And as I said, I've developed a very, very simple, module where you can learn about it. Okay, so I'll just share what module it is, and I'll share the link also below this, video also, where you can learn how to replicate your entire mutual fund portfolio. I did this workshop some time back, but you can take the access of this workshop. Within 1.5 hours, I'll explain you exactly step by step how you can exactly replicate your mutual fund into your own direct portfolio and broad portfolio. Like if you have some 0.5% allocation and all that, you can skip that, but broadly you can map your sectors, broadly you can map your companies. Okay, and within 1.5 hours, you can understand the entire concept. If you want, you can repeat also and you can understand what it is. And I've also shared the link below in the comment section. You can check this out. So please save your fees and go direct. Even if you have like 10 lakh rupees of portfolio, if you save 1% on it, you are saving 10,000 rupees every year. Just think about it. Okay, so go direct. Learn to be efficient. Okay, use a lot of tools. You might think like I'm busy, that is why I'm putting in mutual fund. But even if you are busy, if you use right kind of tools, right kind of methods, right kind of system, you can still be a lot more efficient, right? So that is where you can also use this video which I've created, top 5 stock market analysis tools. You can just check it out, and you can understand how to use different tools so that you can become super efficient. Now, by the way, how many of you are liking this video so far? Just thumbs up, just put a thumbs up so that I know you are liking this video. And Jyoti is asking, sir, stock market share ke bare mein samajhna hai, please. Okay, so this is what I'm explaining. Okay, this is the process. There are multiple other videos. Just go through my channel. There are so many videos on my channel which will help you to navigate and go to the next level in your journey. Okay, so save on the fees, learn to be efficient, be your own fund manager, and save brokerage also. Like what you can do is you can open up a Zerodha account, and you can also save your brokerage also, right? So if you want to check it out, I also shared the link in the comment section below. So something like Zerodha, if you are really a long-term investor, you don't pay any brokerage, and these small savings compound in a very, very big way. Okay, so make sure that you are cognizant of all these small leakages and you are optimizing it on a long run, because if you are really a long-term investor, these things will matter. And finally, 8th thing, which is very, very important, is collaborate. Not many investors do that. They always keep cribbing that, I don't have time, I don't have resources, I don't know other investors. But when you collaborate, you can actually exponentially grow, and you can also find a lot of multi-bagger ideas. Okay, so discuss with your fellow investors, collaborate with them, brainstorm with them, and that is where the magic will get created. Okay, so make sure you are collaborating, and you are also learning from fellow investors. Okay, and what I have done is I have created an investment community where I'm creating a platform where people can learn from each other. So I have something like this, which is a social network. They chat with each other, they share their ideas with each other, they share a lot of updates, success stories and all that. So within your circle, you can, replicate the same thing, that collaborate, and you can also have different friends from different industry, learn from them, and you can go to the next level if you do that, right? So motivate each other, become more efficient, share your ideas, do research together. That is the way to go, right? So hope it is clear. Let me just quickly repeat all the points. So first, respect risk. Second, develop investing system. Third is follow a core satellite kind of approach. The core portfolio is used for capital protection, satellite to find new ideas. And again, there is one more advantage of satellite is when there is a market fall, it will go into cash. So you can also outperform index when you are taking the opportunity when the market is like drastically falling. And if you have cash, you can make most of your portfolio returns also. The sixth is riding your winners. 7th is save on fees, and finally 8th is collaborate with your fellow investors, right? So this is all you need. If you focus on all these 8 points with a real good focus, I am sure you can definitely beat index returns in a huge way. So all the best in your investing journey. If you are not following me yet on Twitter, you can just go to Mashrani Vivek, and if you are not yet subscribed to this channel, please do so, right? So I'm happy to take any questions if you have, but I hope this entire session made sense and it was super clear in terms of how you can execute this entire process. So S Chatterjee is asking, in core portfolio, when a stock falls 15 to 20%, how should one approach that? For example, Infy is down right now, and CNS Nifty is also down. So very good question. So what I do is I put exit indicators there where it is around 25 to 30% drawdown, but it is on a monthly charts. So you don't exit for a 1 or 2 days fall. If it is really falling drastically in a monthly chart, it will take you out. Another thing is, you don't exit when the entire market is falling. Okay, so if the entire market is falling, you stay in the core portfolio, and that is where you can check an indicator called relative strength. That is where different tools and indicators are very useful. So if your relative strength is greater than 0, which means your stock is still outperforming Nifty, then you can still keep it going. Okay, so that is how you can follow the entire core and satellite portfolio. Superb. Ajay Batla is saying, how can I take your advisory service? I don't have an advisory yet. If you want to learn my system, I've shared the link. You can join my free masterclass. And then if you wish to join my community, you are always welcome, right? So you can join this link, which I'm sharing here, which is, let me see if I have a link with me. Yeah, so this is the link. You can join, and you can take the next step if you feel you want to join my community. Yeah, but I don't have advisory as of now. In future, whenever I do, I'll let you know. Yeah, superb. What else? Superb. So hope this video was useful and you got a lot of insights. Thank you so much for joining me live, and check out other videos on my channel. There are a lot of powerful stuff. God bless and take care. Bye-bye. Jai Hind.